It's not just professionals, folks. Retail investors are having a very tough time figuring things out. Charles, one of the reasons I had you here, you are the American investor, the retail investor. The American Association of Individual Investors, which you represent, is a mainstream retail investor group. Your investor sentiment survey, which I watch every week, and been watching it for many, many years, showed 46% of respondents bearish. That is way, way above the average. It's about 30%. What's got the average investor worried right now?
I think it's a combination of factors, Bob. The volatility we've seen in the markets is certainly playing a role, as is Ukraine. But you also have inflation, and a lot of investors obviously see inflation front and center. I think in a mix of all that, we also have the uncertainty of a rising interest rate environment. How much is the Fed going to raise? Right now, it looks like next week we'll get a quarter point instead of half a point. But obviously, what happens after that matters. And then I think as I mentioned to you before, we also have this role of politics at play, where the political views come into play as well. And so those who maybe are more conservative, they're more dour on the markets, have a more bearish outlook in general. And we see a similar type of thing play out in the Gallup polls, where they look at how people view the economy by the partisan affiliation. That plays a role. But I think, if you're an average investor, you're looking at higher food and gas prices, you're looking at a volatile market, you're looking at interest rates rising, and you've had this big run in stocks since the coronavirus bear market bottom. So I think it's a combination of factors at play here.
I'm always interested to see what your membership is owning these days. You did a survey recently of what your members own. You just ask them what they own. And I think it's interesting. We'll put this up. 91% own individual stocks. That makes some sense to me. But 75% own ETFs, more than that own mutual funds. I think it's 72 or 3 that own mutual funds. And here's something very interesting. Only 6% own cryptocurrency. Now, we make such a big deal of the Robinhood crowd because they seem to own nothing but cryptocurrency. And yet the average investor, I think of AAII as the average retail investor, only has 6% crypto. So this tells me ETFs are really making inroads into the average mainstream investor, and even more so the mutual funds. And cryptocurrency, while it's there, is still a pretty small business for the average retail investor.
Yeah, it is. And part of it at play is our demographics. Although we have a very broad membership of about 160,000 members, we tend to skew towards older investors. Our average investor is in their 60s or 70s in terms of age. And I've seen that at other organizations that target individual investors. So that's something at play right there. I think a lot of individual investors, when they look at crypto, they're still not quite sure what it is, how to value it, how to even buy it. So I think there's some of that at play as well, whereas people who are, say, Gen Z or millennial are more comfortable doing that. But I think what you see in ETFs and stocks is I think you have a lot of people using ETFs either for broad allocations or perhaps to get to things like international or bonds, but they're using stocks. And what I've seen over the course of my career is people might be pretty mainstream with their mutual funds or ETFs going for index approaches, but then either they're tilting towards value, they're incorporating trading strategies, perhaps covered call options. So they're mixing the two, where part of their portfolio is probably more traditional, more conservative allocation, but then are using stocks to perhaps be more aggressive or supplement those holdings.
Single stock risk, too.
Yeah. What were you saying?
Single stock risk. I mean, and COVID was, once we realized the world wasn't going to end, it was like, okay, buy stocks, right? And this is a far more complex problem. And I think, as you said, if it's older, wiser, or at least investors that have been around the block, let's say, and haven't just had a bull market, they're going, it's time to take single stock risk off the table and have some ETF allocations. That's where I think that growth comes from.
I wonder, Charles, and I realize that Russia's attack on Ukraine and rising inflation have put commodities into the spotlight. We've been covering commodities for weeks on end here on ETF Edge. But one of the things I always remember about you is you've always emphasized to the members, it's really important to do your homework before you add commodities to your portfolio. What is it about commodities that the average investor should be really careful about?
Well, I think when they look at ETFs or mutual funds, they need to be very clear about what they're investing in. In my latest commentary last week, my investor update commentary, I used a combination of looking at the Spider Gold, GLD, and then there's a Gold Bugs, which is an ETN, GBUG. When you buy Spider Gold, you're actually buying a trust. So not actual gold, you're buying a trust that holds physical gold, versus the G-Bug actually invests in futures contracts. And so it's a case where you're getting exposure to gold two ways, but both times you're a little bit step away. And anytime you start getting involved in futures contracts, you have to realize those contracts are going to expire. They need to be rolled over. But even if you just buy a plain commodity ETF, it could be holding futures, it could be holding assets, it could also be holding individual companies. And if you're looking at individual companies, say Halliburton, Barrick Gold, whichever company you want to pick out, or Deere, you're looking at operational risk there, you're looking at stock-specific risk. So it's not really a case where you should judge an ETF by its name. You really should take a look, see what the ETF's doing, and even among commodity ETFs, see what their allocation is, because their exposure to precious metals, to energy, to agriculture might actually be different by the type of fund or the exchange-traded notes you're looking at.
Are you getting a K1?
Yeah, it's
it's
caused
tax
us no end of
very
problems
important.
for years and years, explaining just rollover risk in owning commodity futures, let alone.
The bigger ones, the more risk.
Well, we saw that with the oil ETF. Remember what happened?